Everything in this video is not intended as financial or investment advice and is for educational purposes only. I'm Josh Olszewicz, the head of research at Valkyrie. Let's take a look at the midweek market update. Shall we? Never a dull moment in crypto, that's for sure. And it became official this week. 3AC, the troubled crypto firm, hedge fund, OTC desk, treasury management, they had their hands in a lot of pies there on what they were doing. Allegedly, they finally defaulted on their loan to Voyager. Now, why Voyager was lending the amount they were lending, I think is a question people will continue to ask and soul search about. But this is part of the reason why Voyager had to reach out for funding from external sources like Sam at FTX and Alameda, because they were deep in the red, allegedly, right? We don't really know a lot of this stuff, what's going on behind the scenes, but I'm going to talk a little bit about the crypto lenders, a little bit about stables and yield, and then we'll get to some on-chain stuff and some TA at the very end. My favorite part, really. I just get through the news because I know everybody's sort of curious what's going on. But for me, the TA is where it's at. So we have these, hedge funds still blowing up, kind of, right? Like this stuff sort of came to a crescendo 2 weeks ago. Now we're sort of finding out more information, who's involved, who owes what to who, right? Morgan Creek put out a counter offer to BlockFi because they're another crypto lender that needed funds because they were involved in XYZ with XYZ party, right? Who owes them money? Most likely 3AC. So there's a lot of backroom sort of wheeling and dealing going on right now between the crypto lenders to stay afloat. Celsius, for the most part, I think, allegedly is done for. I think they're headed for Chapter 11 bankruptcy by the looks of it. Restructuring, the whole 9 yards. Doesn't look good for them. Hopefully these others can figure out a solution where they will be okay. Now, previously I talked about Celsius's on-chain DeFi loans. Those look fine as of now. So Celsius has funds on-chain based on what we can see. Again, we just don't know assets versus liabilities, what they owe to who, right? So we're continuing to find out more and more information. This is Ryan Selkis from Masari saying that, 3AC basically wiped out all of the crypto lenders to varying degrees. Celsius, again, for sure, just likely gone. Genesis, historically the cleanest among them as far as their ability to weather storms and whatnot. They appear to be fine. Their CEO came out and even commented on it. But we're still finding more and more stuff slowly coming out here. CoinFlex, sort of a smaller exchange, doesn't get a lot of press in the US, at least before they halted withdrawals, which is huge. That has Mt. Gox vibes for most of us who've been around that long. You can't halt withdrawals on an exchange and expect people to continue to trust you. So they've come out and said a trader owes them 47 million in USDC. That trader happens to be Roger Ver. This is the CEO. I only bring this up because, it's high drama, obviously, but it's also what's going on. And we have certain parties who owe exchanges and lenders lots and lots of collateral here still. And Roger Ver has come out and said, these rumors are false. So, we'll see what happens at the end of the day. Allegedly, this stuff's going on, right? Some party is saying another party owes them a bunch of money. But there seems to be a weakness in the system if one person's margin long on something blowing up causes the whole thing to halt withdrawals. Like that doesn't sound like an exchange that's operating and functioning as it should, from my perspective. FTX has come out and said they have no plans to buy Robinhood after that rumor circulated this week as well. So there's lots of rumors, lots of happenings, lots of M&A type stuff going on. Now on to Tether, seeing more and more chatter from mostly, I'd say, TradFi legacy side of the world, who I think part of it is they assume that because Tether exploded, which is mentioned here in the Wall Street Journal article, Tether exploded. Tether was an algorithmic stablecoin. Tether was not backed by real world assets. I think a lot of people assume, it's a stablecoin. Of course, Tether's going to explode. Sorry if I said Terra and Tether instead of Terra there, but there's this assumption generally, I think, that from people who maybe aren't as educated on stablecoins that, Tether's reserves are questionable, it's going down, or Tether's just like Terra, it's going down. We certainly haven't seen that yet. Now we've seen redemptions. This is circulating supply of Tether versus USDC. USDC in the yellow, Tether in the pink there. Now we've seen redemptions since Terra blew up. We've seen significant redemptions in Tether, which to me is normal. This is how stablecoins operate, right? Tether's been around a long time. They've never had redemptions to this degree before. That's undeniable, right? They've come out and said, look, we've handled this fine. There's been no issues. I've certainly seen nothing about anybody having any issues with redemptions, which would definitely be the top of the rumor mill list if it were true, because Tether touches a lot of DeFi. It's on every exchange, as is USDC. You know, if one of these starts to blow up or price goes south in a big way and becomes unstable, that's going to create an incite panic and fear and selling and all sorts of issues, right? So I can understand the fear and where it's coming from. I just think personally it's a little silly, but I'm glad people have vehicles to trade their thesis. And, you know, if you want to short Tether, go for it, right? But my point here is that as Tether circulating supply shrunk, USDC gained some of that. So there was a flight to safety here, or perceived safety. And I suspect over time, USDC will overtake Tether based on what's going on here, right? This is the market telling Tether, okay, clean up your act or we will continue to redeem. So market forces are working from my perspective. And if we look at the prices of these USDC versus Tether, both are relatively stable, have been over time, right? Prior to 2021, they haven't been as stable as they are now. Post 2021, they're getting more stable. I mean, we're talking about 4 decimal places out here, which again, to TradFi people might be terrifying. To crypto people, we're like, okay, this is Tuesday, right? We don't care. But when Tether starts to slip here to 995, you know, there's a concern, justifiably, that okay, something going on. Does somebody know something that I don't know, right? Is there some asymmetric information? Doesn't appear to be the case from my seat. But USDC humming along just fine. Tether still slightly below $1. And we can look at open interest on Tether. This is from CoinGlass on FTX, the exchange, and open interest on Tether, the Tether USD or USDT USD perpetual has certainly climbed a lot. And my guess is they aren't long this product, because you certainly don't expect this pair to go much further above $1. So there's been a lot of press, a lot of open interest backing, you know, the idea that Tether's in trouble, which again, I don't really see being the case in my seat. One other interesting thing about stables, the rates on the USDC yield products have come all the way down to 1 on all terms, or on all durations. So this just again highlights the credit crunch, liquidity contracture, however you want to call it. People are calling loans back, seeing who's left on the field, right? So I think this is all part of the game, but it's important to know that rates are certainly almost on the floor. And it makes me question Gemini GUSD rates still at 6.9. I expect these to come down sooner rather than later. I expect all these rates to come down. They have a lot of coins that you can collect yield on, and getting this amount on GUSD. And we know they use Genesis. Okay, again, when I talk about Genesis, that's one of the older crypto lending institutions. Gemini uses Genesis, as does Circle. So if one falls, so should the other. Now, they both don't only use Genesis. I don't know who else they use in particular, but this is still quite high in the current environment. We'll just say it like that. Looking on chain with Bitcoin, Ethereum, kind of the big two. Everybody sort of cares about those two mainly. On-chain activity has started to slump a little bit, but hasn't gone to zero, hasn't gone back to 2012 levels or anything like that. Bitcoin transactions here just flat, not too much to comment on. It's important to know, though, that these values, you look at Bitcoin transactions at 1.7 million per day, and you do some other math with electricity costs and whatever else and carbon, and then you get this number and you think, okay, this is way too much for what it does, but that's sort of missing everything else that's baked into this this metric. If we look at batching, for instance, batching is when we send multiple transactions kind of in one, multiple outputs in one transaction, and you can send up to, it looks like 100 or more, right? Like you can, if you are an exchange or a miner and you're trying to send out a bunch of transactions at once, you can batch those all together. And we can look at over time, batching has grown as a percentage of total transactions. And currently most transactions are sent with a batch size of 2, some 3 or more, right? As we get down here. So none of the metrics you see for the most part really tell you the whole picture on any chain. So it's important to just really understand and know what's going on and what's possible when you're looking at transaction stuff. Something else I haven't looked at in a while is the hodl waves. So this looks at coin age and it looks at when they've last moved. So this is the past year. And in general, as we get closer to all-time highs, we get more and more coins moving. Another time when we get a lot of coins moving that were older coins is when we start to see panic, right? This really represents emotion. It represents panic. It represents fear. And in 2018, that's a great example. We saw an extreme price drop very quickly, and we saw a rapid rise in coins moving in the past week that hadn't moved, coins moving in the past week from months prior that had been held, right, and not moved. So we haven't seen that yet. We haven't quite seen a mass panic fear in this data. And this is it's iffy because there are other ways to move coins around besides on-chain now. So this gets less and less powerful compared to days of old when all there was on-chain activity. But it's still interesting. We've seen it, it's upticked a little bit here, but there's not a lot of people panic selling. That's my takeaway from this so far, right? There's not a lot of people getting out the cold storage and sending it to exchanges based on this data. Something else relative to on-chain activity would be MVRV, market cap versus realized cap or realized value. And when the market cap is several multiples higher than the realized cap, which is the value of all the coins that have moved on average since the last time they've moved, when that's extremely high, we've typically put in an all-time high, right? And the inverse is also true. When that sits at a lower value for an extended period of time, that typically represents a period of accumulation. Another way to think about this is just how much unrealized profit do people have, right? If we're looking at when the last time coins have moved on chain, that's probably the last time they moved them to sell. Again, it's not a perfect metric, but gives you some idea, right? This sort of says, a lot of people don't have any realized profit here. If anything, they're underwater, on average, because the last time the coins have moved was above the current market cap. So yes, this can go lower. This can stay this way for a year, right? We can stay in this range, but it's a good sign when you're looking for bottomy type things or accumulation levels. This is one metric I love looking at because I hate saying never, but it's really never been wrong. We've been in this zone 3 times previously when it has been accumulation. Doesn't mean it can't go extremely negative, but it is a good sign. Looking at ETH is curling down on the transactions fairly aggressively here. And I don't have a good reason for this other than potentially mining related. Hash rate has dropped about 15% from highs, and mining related transactions are sort of baked into this as well. If we're looking at the entirety of the network, mining is always a part of that if it's a proof of work chain. So we're definitely seeing a curling here of activity, DeFi stuff slowing down, right? Yields, as I showed with USDC, coming down significantly. So it makes sense, price coming down, activity coming down. Something I'll be continually watching for is whether or not activity starts to pick up again, right? Then you have a divergence between on-chain activity and price, and it's a good sign that we've started to turn the corner price-wise eventually, right? There's no promises there, but you do need on-chain activity to pick up typically for price to follow. So it's not unusual to see those two correlate extremely closely. Active addresses is another metric to use when you're talking about on-chain activity. Again, for Bitcoin, flat, slightly down, nothing super significant to comment on here. And if we look at ETH, same thing, active on-chain addresses relatively flat, certainly at multi-month lows, a year low, right? Whatever, however you want to think about this, it's at lows, but it's not at zero. There's still plenty of activity here. As far as mining is concerned for Bitcoin, mean hash rate, average hash rate, down from all-time highs slightly. We're seeing reports of miners needing to sell to cover loans, miners being inoperable because of weather, miners dealing with variable load in Texas, right? There's a lot of energy side of things going on, as well as credit issues going on. So it makes sense to me that hash rate is stalled a little bit here, and it wouldn't be unreasonable for hash rate to continue to decline as it sort of has every time we've had a bearish market like this. And if we look at difficulty, so hash rate is the raw number of crunching power on the network to solve some equation. Difficulty adjusts every 2016 blocks to make sure there's a 10-minute block time. And the next difficulty adjustment is set for a week from now, and it's projecting a decline in difficulty. So it's baking in that hash rate decline. And if we look at historically over time, Bitcoin mining difficulty, these do correlate again with bearish periods, bear markets. We typically see the most extreme difficulty adjustments to the downside in bearish periods as well. So it's not something we've seen yet. If we're trying to check all the boxes for things we've seen in previous bear market bottoms, this is definitely one of them to watch, and we'll get a lot of headlines because you'll see hash rate come way off, difficulty come way down. A bunch of miners publicly say, we had to shut off because XYZ reason. I think that is coming. Now, this isn't going to lead to like some death spiral on the network, but hash rate will likely decline here. And this is ETH's hash rate. Like I said, this is down 15% or more from the highs here. And ETH is a little different because they are moving from proof of work to proof of stake, so there won't be any miners on the network at all, probably by the end of the year. And I think some of these guys are starting to pack up shop early and realizing, okay, let's move on to a new game, because their entire revenue model is going to disappear on Ethereum. Now, they can always mine anything else that their equipment allows them to mine, but it's not going to be Ethereum. And as far as I can tell, nothing is as profitable as Ethereum. So this hash rate will go somewhere, some of it will be shut off, some of it will flood the GPU market. As a gamer, I can't wait to buy a cheap GPU. Finally, after years, you can map the GPU price market with ETH's rise in hash rate. So GPUs should start to fall quickly because there's going to be a supply on the market flood here. Moving on to more technical type stuff, BTC and ETH on a 30-day rolling correlation still basically at all-time highs. You don't see that in a bull market usually. You can flip through these and sort of see we're still pretty correlated. That's not typically something that's rather bullish. The S&P correlation to BTC falling slightly on the 30-day. It was at all-time highs. It's falling slightly. We're still historically, quite high. So you do need to pay attention to legacy if you're in crypto at all. And against the dollar, we're strongly inversely correlated. DXY, that hasn't really changed too much. And against the VIX, we're also strongly inversely correlated, which hasn't really changed too much. So, something like the NASDAQ, from a purely technical perspective, volatility needs to calm down and we need to not just continue to sell off, every single high we get. Now, if you're in the camp where you think Fed's going to keep raising rates, market's going to keep bleeding, you're probably also in the camp that thinks crypto is going to continue to bleed lower, right? You could be in the camp where you think the Fed's going to reverse course or halt rate rises in maybe September range. Maybe we get some relief. And then the third camp is we're going to decouple from legacy completely. I don't think we're quite there yet, but there's some mixture of what are we going to do when the Fed slows rate hikes or halts them? That's a possibility, not a likelihood, but it's a possibility. Something to think about. DXY, again, it's not great to see DXYs since 2015. If we are inversely correlated with DXY, just broadly crypto, it's not great to see DXY at highs still, at a multi-year range still. So we either need to decouple or legacy needs to reverse its current trajectory broadly. Looking at BTC specifically, we're still slightly below the 200-week moving average, certainly below 30. right around 20-ish, right around the 2017 all-time high. And no bull div yet, just quite on momentum as far as RSI is concerned. And there isn't really too much to say on high time frames, chart pattern wise, trend wise. This just is still sitting in oversold territory. But we are in very interesting times macro wise, as well as everything I talked about in the beginning with crypto lenders and liquidity contracting, credit contracting. We're not quite out of the woods in that regard just yet. Something interesting I saw this week was the power law corridor, some regression model that looks good. Again, statistics, you can sort of use it, massage it to say whatever it is you want it to say. But historically, if we're just looking at backtesting, again, this thing has held up quite well, helping you determine accumulation zones. And it's not unlike the rainbow chart, very similar sort of thing. Gives you some perspective on historically overbought, oversold conditions. The 2-year MA multiplier, very similar to that. Again, this isn't saying this thing can't significantly sell off. It just says, hey, historically, this is where we've had oversold conditions and accumulation has started in these areas. The green is the 2-year MA, but red is 5 times that. I just like things that are simple and have worked over time. ETH, a little bit different. It's closer to the 200-week moving average, but it's farther below its previous all-time high. And again, there's nothing too significant to comment on here. There were some lower time frame reversally potential patterns that haven't really played out just yet on BTC and ETH, but they are something to consider on low time frames. Looking at the DeFi perp, DeFi is just taking a absolute slaughter. This is an index of DeFi coins by market cap, so it's weighted by market cap, and you can see it's just retraced all of 2021 completely. It broke out in late 2020, sort of near the inception of this index, and it is retraced that entirely at this point. It does have what I would consider a bullish divergence down here. It does have a lower low on a higher RSI, so you're seeing less momentum at this low. Not a definitive sign, right? There's no holy grail of bottoms or bounces or whatever you want to call it, but this is something you definitely want to see is bearish exhaustion if you're bullish, right? If you're on the other side of that. We can just flip through all these comp USD far below its open, its low in 2020, and you can just see these moving averages split apart. This is the 50 and the 200. Now, do I think comp USD personally is a great use case? Coin-wise, no. I love the product. The coin doesn't make too much sense to me. But on a technical basis, people are probably going to start looking at this stuff, thinking about it. Wi-Fi is a classic example of the coin to me. Don't know why it exists. And it's sold off significantly from nearly 70,000 per coin. Wi-Fi is a yield product. The product itself, I think, is fine. I think it's great. But again, the coin, the fundamentals behind the coin make no sense to me. Sushi is an exchange. Their coin as well, just retracing all those gains from 2021. Bull div there as well. Solana is an interesting one because you also have that bull div here. We're at the previous May, June, July lows, far below the 200-day moving average. Solana has a million problems working fundamentally as a blockchain. And I think the market's gonna figure out what's going on here fairly quickly, because this is a rather large chain that has a big community, developers, all that sort of thing, that may be looking at significant downside still, even despite how this looks, TA-wise. Fundamentally, I think there's some issues here. Not just Solana, there's a lot of chains like that, but just pointing to this one in particular. And lastly, if we take it off log and we just look at it linear, again, it's retraced all of this FOMO hype euphoria completely. So to me, broadly, I think we're closer to a bottom than we are to a top. Certainly, I know that's a brave call, but to see exchanges blowing up, to see crypto lenders blowing up, hedge funds blowing up, Ponzi's blowing up, all of that's getting brought to light. We're seeing yields come way down. We're seeing stablecoin circulating supplies contract. We're seeing hash rates decline, right? Miners are in stress conditions a little bit based on profitability. And TA historically is leaning towards more oversold type conditions broadly. So that's all I have for this one. Like, dislike, comment, share, subscribe. Happy trading.